All right, thank you very much, guys. We've got a few different topics to cover today. Obviously, there's been a start of a shift, and I think part of the panels have been covering this already, the shift from large caps down into small caps, which will be something that we touch on really well, as well as just the change in investor sentiment and how small but growing listed tech companies can really engage the market at the moment and capture that interest. Before we jump into all of that, I might just throw to the guys to give us a sort of a 20-second intro on yourselves. Shaun, do you want to start?
Thanks, Ben. My name is Shaun Cartwright. I'm the Chief Investment Officer of Anadara. We perform investment banking functions. We run a few managed investment schemes, and we issue structured products.
Cool.
My name is Lowe. I'm the CEO of Integrated Research. We're a global software business based in Australia. We sell what's called observability software to large enterprise all around the world. So world's largest banks, large government organizations, big in retail and healthcare. So we're essentially a big data business that's leveraging AI to move into a new growth phase of the business.
Great. And Mark?
I'm Mark Goranson. I'm CEO of Nanoveu Semiconductor division. And so in this role, I'm actually bringing an edge AI processor that's super low power, super capable, that can go into just about any wearables or edge device using very little power. I have over 46 years of experience in other semiconductor companies. I was actually retired, and then they convinced me to come and take this challenging opportunity to bring this technology to market. So here I am.
Very nice. Well, welcome back into the market, that's for sure. Ian, I'm going to throw to the first question to you in a minute, but I think if we sit back and have a look at what happened a few years ago in the market, sort of for the decade before 2022, the market was really grow at all cost. It was all about top line revenue. That's really what investors wanted, and the real fundamentals of the business were quite a big secondary to that. I think looking back, it feels like that kind of flipped overnight. And the market really took a view of, well, why aren't you profitable now, and how do you get profitable? And there was then that question between profitability versus growth. How has that evolved, and how has that impacted the business over the last few years? And what are you seeing in terms of investor interest in the conversations today?
Well, look, our challenges and opportunities are completely independent of everything you've just referenced. And that doesn't mean that they don't coincide at different stages, and understanding that nexus is important for any business. Money flows to where it ultimately will get growth and returns, and the mixture of that depends on a whole host of different things. And you could talk to 10 different flavors of capital and you get 10 different perspectives on that. As the CEO of a software company, I'm actually not even really thinking about that, certainly as a listed company. We are focused on one thing, which is sustainable, profitable growth. And that's really all we need to be good at. How the market chooses to value that at different times, I'm not interested in trying to be too clever about that. Because first of all, whatever it is today, it is going to change. And I can't pick the nature or the timing of that shift, even though I might see sort of the macro trends and the evolution of those trends. The fundamental focus cannot change. Private or public company alike, you're fundamentally valued by a group of optimists called investors, and they are valuing on your future and your potential. So I've just got to worry about that. If I get a bit too clever about trying to tap into a certain sector of the market that I think is going to grow and might give me a higher valuation, I'm really missing the main game. So first order of business for us is the business, and profitable growth is the game.
Yeah. Nice. Mark, have you got a view on this from your side?
From my perspective, it's all about the growth side of it, because we're lucky in the semiconductor business. It scales really well and profitability is built in, so we can focus on growth. Now, we don't just grow at all costs. What we specifically have done is to have a laser focus on where we are truly going to add value and where we're solving real world problems. For instance, drone market's growing at unfathomable double-digit growth, and we can actually improve the drone flight time by double, and so that's solving a real world problem. We can go in wearables and we can look at all the different characteristics of the human body, and through the AI we can flag if there's a health condition or not. And so we've specifically looked at where our processor is ideally suited, where we can have good customer traction, and then we can get good market growth and good profitability. So it all kind of stays together, and it's not one versus another. It's just hitting the sweet spot where we can actually leverage it and be able to get fast acquisition of customers.
I like that both of you are taking that question back to the fundamental of the business, right? Like that internal profitable growth focus, which will then, as you said, Ian, have that regardless of the market appetite or the way it values companies at different times. That's always going to position you in the best way.
Yeah, and similarly, profit may trail growth, right? They're interdependent, but they're somewhat mutually exclusive. So you can focus on growth as a means to get to the profitable growth, but in the end, it's the profitable growth that is the prize that will be valued the most.
I also really liked your how you termed investors as optimists instead of investors. I like that. I'm going to steal that at some point. Because you're right, they are valuing the future value of the business. They want to participate in that growth. On that point, Shaun, the optimist in the room, what are you seeing at the moment in terms of the market? And do you think there's been a shift recently?
Yeah, absolutely. So just before we sat down, the ASX just hit a fresh all-time high. And for a lot of the companies in this room, I guess they're wondering when their turn is going to come, because if you have a look at why the market's so high, it's 30 or 40 stocks that are getting a lot of the institutional flows come through. What we're starting to see is capital start to trickle down into the smaller companies and but just trickle down. And interest rates have got a huge part to play in where we're seeing capital flow to. So when interest rates were raised rapidly in 2021 or 22 or whatever it was, that was when a lot of the risk capital left the market and left the smaller end of the market and venture capital markets. And why wouldn't it? Investors were able to get 15, 20% guaranteed coupons in private credit markets. And so a lot of the smaller companies were starved of that risk capital. As interest rates start to come off, we're starting to see money leave the private credit markets and flow back into equities. And we're starting to see it trickle down from the larger cap companies and into the smaller companies. So we think for the small and micro caps, it's hard to put a time on it, but we think we'll start to see more significant flows into this end of the market probably in the next 12 months. So it's probably not a bad time to find businesses such as your two that are focused on sustainable growth, because companies like that will probably the ones that get the money first.
Yeah, and I think to give some stats to that perspective, so as you said, the ASX 200 just hit a all-time high of 91.11?
91.12.
91.12, sorry, I was off. 91.12 this morning. But the ASX 200, by definition, is 200 companies. It always has to be 200 companies. And it's about 9% of the number of companies on the ASX. But it represents more than 91% of the market cap of the entire ASX. So you actually don't need that much to trickle down for it to have such a disproportionate impact, right? Like 4 or 5 percentage points moving down will add 50% to the balance 2,000 companies. And you think about that from a liquidity point of view as well. Yeah. Mark, you've had, I would say, an increase in liquidity over the last few months in the stock. Have you noticed is that the drone related announcements, or is that other information, or are you noticing an increase in investor demand in general?
Yeah, so that's a great question. So, there's been a couple of big advances that has hit the wires, and both of the couple have been able to do that. One is the drone, of course. That was a pretty big deal. And then we've really been publicizing all of the solutions that we can fit the technology into. And so people are starting to understand what Edge AI processor is, and then all the solutions that we have, because most of the people, AI has been hype. And so before that, people weren't willing to really look at AI too much because they didn't really understand what Edge AI was and how it solved real world problems. Once we started really communicating that through a variety of public events, LinkedIn, a lot of different analysts have started covering us, and we've been able to show that, hey, we can be ubiquitous. We can go into just about any device you can imagine. We can improve efficiency. We can improve safety. We can improve knowledge at devices right at the place where the knowledge needs to be done, instead of keep shuttling all the information to the cloud, which is where most of the AI processing takes place now. We can actually do it on the device itself. And so your watch or your ring or your wearables don't have to communicate with the cloud. It can do all of that capability real time. And so if you have a heart condition or you're going to go into an epileptic seizure, our technology can figure that out and warn you before it actually happens. And so when people start hearing all of the things that we can do to help really solve problems, and that's helped the liquidity. And of course, once we start getting commercial traction, then you're going to see it go even bigger.
Yeah, nice. You spoke about the sort of the double announcement sort of build on that. And I remember talking with a private investor 3 or 4 months ago, and that's a big yardstick for what he uses to see whether the market is back. So whether you've got, if a company puts out a great announcement, it's usually going to have a great response. But the real test of the market and of the stock having the momentum is if it has that response and then maintains that share price. So rather than sort of the jump up and then the sell off, if you get the jump up and sustaining, that says that all of your, I guess, tired old investors are sort of gone out. There's enough volume to maintain there. And then you've reset the expectations for that next news flow as well.
Right.
Yeah. So it sounds like that's happening for you.
That's exactly right.
Ian, it hasn't been as fun for you guys the last couple of months.
No, we've got a very heavy retail representation in our shareholding and our register, and we're embarking on a product-led growth strategy that's going to take 2 to 3 years to deliver a new growth trajectory for the business. And so it's always a very small subset of the retail investor that's going to go for that ride. So the investor that's right for our business, and we're right for that investor, is really a higher conviction investor. It's patient, understands what progress looks like, which, by the way, is our responsibility to help them understand that, and is looking for those markers of progress and goes on that journey to a new growth trajectory. So that's a very particular type of investor. I mean, to your earlier point, there's clearly a view that a lot of the bigger organisations on the ASX, for example, are overvalued. That money's now looking for higher returns, and so it's trickling down into the smaller cap organisations. So there's renewed interest in businesses like ours, very well established, 35 years, proven technology, blue chip client base, great DNA in the business, which is very much aligned to the future needs of those same clients. Investing aggressively to leverage AI, build new products, sign new customers, upsell, cross-sell existing customers. All of that really speaks to a growth investor. And those growth investors are becoming more interested in smaller cap opportunities such as us. So, you know, the winds of change are broadly at our back. We've still got to be good enough to deliver it, and we think we are. So, but the investor that will come on that journey with you, you talk about sort of getting a rally and a price and then at holding, that suggests that you've got investors who are coming in and they're along for the ride.
Yeah.
Right? They're not going to take a 10 or a 20% yield in a 2-month time frame. They want the 5x or beyond. So that's a particular type of investor that we're seeing a lot more of in our business.
Nice.
Yeah.
Shaun, on that point, the sorts of things, you know, one thing when people step down, I think, from the ASX 200 into growth companies is not only a valuations, multiples are lower and more attractive, but the other thing is true that there's literally 10 times as many companies to pick from and invest in, right? What are some of the things when you're looking at those investments, like if we're thinking about tech companies, what are you looking at? Is it the profitability side of things so that you understand whether there's going to be a capital raise or a dilutionary impact? Is it any sort of impetus or management change or the like to be a catalyst? Is it sort of more macro trends like AI and drones are really good examples of that?
Yeah. So
is it all of it?
yeah. So kinda. I think the job of a CEO of a small or micro cap company, it's so difficult because as an investor, if we sit down and we speak to 10 CEOs, we'll get 10 very similar stories about how exciting the growth is, how amazing everything is, and I forget how many companies, 3,000 or so small cap companies on the...
About 2,000.
Oh, 2,000? Yep. 2,000. They're all competing. They've all got their spot on the shelf and they're all competing for the same buck. So it makes it really difficult. One of the things that we do look at, so sustainable growth and profitability, although there aren't that many companies at the smaller end of the market that have those benefits. So we have a look at things like capital structure. So one thing that we really dislike is hundreds of millions of broker options and things like that sitting out there. We don't like unreasonable remuneration for multiple advisors, large boards. We don't like to see boards wasting money, especially when you've got whatever it is, I think 15 or 25% of your market cap's all you can raise each year. For some of these smaller companies that have got a $10 million market cap, they can only raise a couple of $1 million a year. And so we want to see how they plan on spending that money. And it's quite often when we meet a company, we won't consider an investment for 6 to 12 months after we meet them. We'll want to see whether or not those businesses have been able to deliver on the things that they told us earlier on.
Sounds like a lot of your points I'm sort of pulling together around execution, which is what the guys were talking about before, right? Like remove the so the broker options, which actually just dilute the execution. Remove the spend that takes away from execution or communicating right the story. 6 to 12 months so that you sit there and you say, this is how we're going to execute. And then by the time you actually do invest, have they done those initial things?
No, absolutely. It is, I mean, the conferences like this are fantastic for getting exposure to a lot of, there's quite a few decent investors that I've seen around the room that do make decent size investments into this end of the market. So I think these are great things for CEOs and IR firms to come to present their story. But it can be very tiring and draining as well when it takes important people away from the business. There are some companies I see, and I swear they must just be on a never-ending conference circuit. I fly internationally at least once a month, and the amount of times I see the same guys in the airport, it leaves me to wonder when they ever actually work in their business. So, yeah, there's a lot of little things, but I think you've summed it up, Ben. It's execution. We like to see that boards are able to execute.
How do you guys feel about balancing that?
No, I think that's exactly right. Anybody wants to, they don't want the hype. You know, the hype is good to get the attention, but at the end of the day, it comes down to the execution. And so, you know, we're laser focused on not spending $1 until we absolutely have to. And we're trying to use self-funding to take most of the growth in the company. So for instance, you know, we have a technology that's ready, it's already baked, it's ready for commercialization. Instead of hiring and building a commercial team, we're utilizing representatives across Europe and US and Asia and not hiring them, but we're actually just paying for incentives. So you get a bonus if you get a design in, if you get a LOI, a contract, because at the end of the day, the thing that's going to make the valuation of the company grow is customer acquisition, right? And so we're just laser focused on the key areas that we know our processor is perfectly suited for. We know it solves problems. We know that we can get customer traction. They're not the big guys that are going to be slow to adopt it, because, you know, the big guys are going to be hesitant to take on new technology. So we're really going into the smaller guys that are willing to be disruptive. For instance, you know, now all of a sudden, if we can get 20 times the battery life on a ring, you know, the guys who are competing against Dora, they'll take the risk. They'll say, yeah, I can be a market guy, I can take market share for Mora. And so we're focused on the guys who are second and third, but not the guys who are leading. And so we have pretty much done the Venn diagram of what is the ideal customer, what is the ideal technology, when can we get customers, and we're utilizing this sales force on an incentive basis who already have these relationships. So we expect to be able to get fairly quick customer traction without using a lot of our own money to do that. So that's kind of how the model that we've kind of played into, and that rings pretty true with most of the investors. They like that strategy, and I think ultimately it's going to make the company grow at, you know, not diluting and using a lot of our cash.
Yeah, nice. It's as you say, it's a good way to focus on that profitable growth as before. And you guys have got lots of fantastic customers, and I think your business from a investor point of view is probably more difficult to understand than from your customer point of view. If I had to guess, they probably understand it better. Would that be a fair comment?
Depending on the investor, probably.
Yeah.
And we're a little bit different in that, you know, we've got a really strong balance sheet. We've had a couple of very profitable years, and all of our ambitions for growth we can fund. So we're not looking for capital. You know, this event for us is really about broadening the radar of investors that may want to come on that journey with us, right? But in the search for capital, one of the things that I have learned along the way is that don't try and sell your business to everybody. Find out if it's the right person. You know, have the confidence to really understand if the person you're talking to is the right investor for you. And if they're not, tell them. There's an authenticity to that is really good for a business and saves everybody a lot of trouble. So when we're speaking to people and it becomes clear that this is just not the right profile of investor for us, I will tell them. I'll say, look, we're not really right for you, and I don't think you're right for us. But all of that could change, and so let us know if it does. Because there's a conversation that I could be having with somebody that is the right investor. So, you know, when I started out running ASX companies 20 years ago, I was trying to convince everybody how great we were. And because I'm a slow learner, it took me a while to work out that's actually not the objective. There's lots of flavors of capital out there looking for a good home. You've got to find the right flavor. And part of that is having the discipline of identifying ones that are not right and just moving along quickly. Yeah.
Well, what else have you learned? 20 years is a good innings. Any other?
Look, the one thing a bunch of things, but every business lives and dies on the strength and the quality of its people. It's just a universal truth. A great idea in the hands of, a not great team will fail. I'd rather place a bet on a not great idea in the hands of a great team. That's really just to make the point. Obviously, what you're looking for is great idea, great team.
Yeah, I think there's a Steve Jobs quote in there around when he was asked towards the end of his life, looking back at all the things that he'd built, all the different products, right? Obviously, culminating in kind of the iPhone as the most iconic. And he was asked in his his biography, what's the product that you're most proud of? What's the number one thing? And his immediate answer was the team. Because to that point, like none of those products would be, so ubiquitous and so like literally in our hands without that team. The idea just doesn't do enough, I don't think. Sort of if we look at that point around being capital independent, if we look at the point around like if we think about what being listed is, right? Being listed gives liquidity to stocks and it gives access to capital when needed. They're the kind of main two reasons to be listed. I think there's been a lot of debate over the last few years, especially as it's been a harder market in the listed market around being public or being private. Do you guys still feel value in that? And Shaun, from your point of view as well, do you look at much of a difference between public and private companies?
Yeah, this is actually a really good question and topic. I think, what was there, 2,000 smaller companies on the ASX? I think 1,000 of them probably shouldn't be there. I also think the ASX is probably one of the worst exchanges in the developed world. They operate in very opaque ways, not a very clear and consistent application of rules. And I think that when you come to work in efficient countries with efficient exchanges like Hong Kong and United States and Singapore, maybe not so much Singapore, but where there are very clear and consistently applied rules and there's competition, I think you get better outcomes for smaller companies there. I think the mistake that some of the smaller companies make when deciding to list is I don't think they understand what it means to be a listed company. And I think, Ian, with 20 years behind you, I think you can probably speak to this, but the responsibility, the time and the cost, I think I made a point a short while ago, you can only raise up to a maximum 25% of your market cap each year. Listing fees are about $500,000 or so, plus you've got audit, plus all these other things. Plus you've got to pay your board and travel to these things. It doesn't leave much money left for actually building your business.
It's not as bad as that.
Okay.
Yeah, the top. I think it's the top 10, 15 companies pay $500,000 to $600,000 a year. Yeah. The average ASX fee just for being listed, none of the extras, etc., is about 36, 45 around there. But you're right. Like as soon as you're listed, your audit cost goes up 400%, right? Yeah.
But there's 100 other costs that have got nothing to do with listing fees, right?
No,
you've got governance cost and overhead. You've got directors that will expect to be remunerated at a certain level given that exposure. You've got insurance policies to protect them. So it just goes on and on and on. The grief to profit ratio really needs to be looked at for anyone that's up for this, right? Because, I used to have hair and it does take its toll. The other thing is, having many years ago co-founded and grew and listed a business from scratch, you got to be a bit careful. Listing is a bit like getting married. And just hear me out on this analogy. It may or may not work. But the wedding day is a big day, and right. So for particularly for an external investor in a privately held business that leads up to an IPO. That's the harvest event. So for them, it's all over at the wedding day, or substantially. That's the payday. But actually, it's the sort of the next 50 years that you've got to show up for, using the depending on what age at which you get married, of course. And it's a bit like that listing a business. It's a daily commitment that takes a toll, and so the rewards have got to be clear in your mind, I think, and need to be universally understood, I think, certainly by major shareholders and the founders of a business, and everyone's got to really be up for that. Yep.
Yeah, I completely agree. I think that a lot of companies, and we invest in a lot of earlier stage companies as well, and I've had a lot of conversations with a lot of founders and CEOs, and I think a lot of the times there's ego about being CEO of a listed company.
CEOs don't have egos, do they?
Oh no, well, certainly not. But
That's not right.
but,
I don't have one.
no, I'm just saying that sometimes they're blinded and not aware of what it's going to mean for them and their company, and their understanding of what it's going to take. And then, of course, there's a lot of really dodgy brokers out there as well, that really don't have companies' best interests at heart, despite what they tell you. And it can be really difficult until you have a market cap big enough to be looked at by some of the bigger, more established brokers that can get genuine institutional investors to you. So I've seen a lot of fantastic companies, or fantastic products, I'll say, not companies, that have just been destroyed by bad capital structures, by working with the wrong type of brokers. And I do everything I can to encourage the unlisted companies we've invested in to stay private for as long as they possibly can.
There's another big part of that, isn't it? Where you don't get to argue your valuation as a public company.
No.
Right. So depending on where you sit on the up or down of that, might inform your view about whether or not it's good or bad.
Yeah. Well, I think if you ask any listed CEO, they'll always say they're undervalued, right? I think in 8 years, I've had one CEO tell me, "Oh, it's about right."
It's in the job description.
Yeah, correct. Yeah, it's like an STI basically. I think we've got sort of 5-ish minutes left. We've touched on it a little bit. Kind of loath to talk about AI because I feel like it is a little bit over talk, but it is such a large part of the tech market. Mark, I'll go with you first because you're getting up to present in a few minutes, so I'll let you have a little rest afterwards. But like globally, some of the listed deals that are happening kind of start to beg a belief a little bit, where one company will invest in another to then buy services back from them. OpenAI has done that sort of 3 times now, which has been a really interesting trade and structure, which gives a little bit of hesitancy looking outside in, saying like that feels more hype than real. But when you're looking at the actual deployment of technology and use, and then Ian, afterwards for you as well, as you start to move the business into that sphere a bit more, is it real or is it hype, and to what extent?
So there is a lot of hype out there. There's no doubt about it. And so part of our strategy is to stay away from the hype. And we really try to keep the company, our stakeholders, everybody just focused on what problems are we solving? How do we solve those problems? And then the money will take care of itself, but we don't want to stay, we try not to get too much in the hype. And I can tell you that the hype can either work negatively or positively, because we've actually worked with some OEMs and their eyes glaze over and they say, we don't use AI in our device. We don't know what AI is. And so we have to go through and educate them on the benefits and what it can do for them. And so we try to stay away from the hype as much as we humanly can, because it actually, for the most part, is a negative for us, because people see it, they just glaze over and they say, we don't know what to do with AI. And so now what we do is we say, this is how we can improve your life, how we can improve your product. Like for the drones, we just say that AI is the tool, but this is what we can do for the drone, or this is what we can do for the ring or the watch or the wearables. These are all the capabilities that we can do. We can add to your battery life. We can add these fundamental things to you, and this will help you be able to compete against your competitors. And so we really try to keep them grounded on the solution to their problem and how they can grow, how we can add value to their product and technology, and stay away from the hype, because you're right, there's a ton of hype out there, and you know, AI is it. And they try to ground a lot of technology and hype, and so again, we try to stay away from that aspect of it.
Nice. So real bringing it back again to that fundamental of delivering on real problems, right? And then the actual technology is almost independent of that.
Correct.
Is that the same for you, Ian? Or you said that you're sort of going back to a renewed 2 to 3 year product-led growth strategy?
Yeah, so we're a little bit different to some companies in that we are a big data in real time business pre-AI. So we are always going to be a great candidate for the benefits of AI, because we can run AI straight through the heart of the data that we already have today and create new value. And so that's exactly what we're doing. So we have the benefit of being having DNA that's very close to all the things that are possible with data, and we've got this shiny new thing called AI, which makes lots of new things possible. So for us, the application of AI is not just sensible. We would be negligent if we weren't pursuing that path, right? But by the same token, you know, I think just more generally, as we look to apply AI in all sorts of different interesting ways, and there's certainly lots of jazz hands out there in that world, is just making sure that the regulatory frameworks around what we should or shouldn't be doing with AI, it's a bit like blockchain. It's just way behind. It will not be able to keep up. So we have to find ways to wrap good governance around the utilization of AI. There's no greater call to action around good governance than being a listed company, because you can't mess it up. You know, the price you pay for that is significant. So AI is really big for us. It's a really logical progression of what we already do, and we don't even need to collect more data to do great things with AI. We're going to launch our first AI product very shortly, and we're super excited about that. Yeah.
Awesome. Good luck with it.
Thanks, mate.
Yeah. Shaun, 60 seconds, AI. With your view, when you say you take that sort of 6 to 12 month view before even making the investment, and then I assume like more than 6 month view on the longevity of that investment, how does it factor in, or does it factor in at all?
Yeah, it absolutely factors in, and I'll just say that the 6 month lead time, it's with companies that aren't well researched. So for Magnificent 7 stocks, for example, it's easy to find as much information as you need to make an informed decision straight away. Just on the Mag 7, I think we're getting into a bit of an AI bubble, and I think if you look at the Mag 7 now, they're 31% of the S&P 500. If there's a 10% drop in those 7 stocks, it's just over $2 trillion wipeout of the S&P 500. That's almost 4%.
That's the value of the ASX combined.
Yeah. So when you start to think about that, at some point, they are, in my view, and most analysts' view, overvalued. People are now, if the Mag 7 take a bath and come off 10% or more, I think it's going to hurt other tech companies as well, because investors will start cycling. They'll say tech's dead and whatever. So, yeah.
So I think that's a really good point. There was a panel yesterday on explorers that Kevin did. Explorers versus sort of developers from a mining point of view, and it's a little bit the same with early stage tech versus Mag 7, right? Like, you don't necessarily need to pick one or the other. But as an investor, if you start taking a little bit of money off the table from those larger companies, which de-risks your position there, and start putting it into fundamental growth businesses that are focused on that profitability, solving real problems, you kind of get that de-risk from the top, and then the ability to participate in much higher runs. Because I don't think anyone looks at small cap listed in Australia and goes, well, they're clearly overvalued. Right? I don't think anyone's doing that piece. So we're all done. Thank you very much, guys, for joining me up on the panel. Mark's actually going to almost stay up here and give us a run through of the business. And I think, Ian, you're back in about half an hour or so. I think so, yeah. Shaun will be around, as will I. But thank you very much, everyone. Thanks, guys.